Thank you for tuning in to this installment of Business Break. I am Tamara Carasa, and with me today I have Jeff Daniels. Today we're going to talk about commercial leases, tips and traps for tenants when entering into leases. Leasing an operating space is often one of the most significant expenses a business is going to have. Just as when you lease an apartment or a new car, you're going to want to make sure that entering into a commercial lease is a task that's not taken lightly. The majority of the time, a landlord is going to provide their own form of lease, which they may have had a lawyer prepare, or it may be adopted from something they found online. The lease is then negotiated between the landlord or the tenant, and often this can include the assistance of lawyers. The terms of commercial leases vary widely, so it's important for tenants to review each lease in detail. If you're not comfortable with the language of the lease, it may make sense to have a lawyer do at least a review of the lease to point out some provisions of the lease that you may want to consider in more detail. This presentation is intended to point out a few of the common tips and traps that commercial tenants should be aware of when entering into a commercial lease. We're going to talk today about types of leases, operating costs, renewals, and some other tips for common provisions that you will find in a lease.
Leases generally will fall into two categories, either gross leases or net leases. Gross lease is the more simple form of lease, and in a gross lease, a tenant will pay an all-inclusive lump sum of rent to the landlord, and then the landlord will be responsible for the other costs associated with the lease space. This includes the property taxes, common area maintenance, utilities, and the landlord's property insurance. Net leases are much more common. In a net lease, the tenant is paying the basic rent or minimum rent, depending on how it's defined in the lease, and some additional costs that are associated with the tenancy. These additional costs are usually estimated in advance and paid together at the same time as the minimum or basic rent. Net leases can be divided into three further subcategories. In a single net lease, the tenant is responsible for paying a set amount of minimum rent and, in addition, paying its proportionate share of property taxes. The proportionate share would be calculated by taking the ratio of the lease space that the tenant is occupying over the entire rentable area of the building. In a double net lease, the tenant is responsible for paying basic rent and, in addition, its proportionate share of property taxes and the landlord's property insurance. Again, these amounts would be estimated in advance and paid together with minimum rent in monthly installments. Triple net leases are the most common form of commercial lease. In a triple net lease, the tenant will pay base rent, its proportionate share of property tax, its proportionate share of operating costs, and in addition, its proportionate share of the landlord's insurance. A triple net lease is designed to be carefree to the landlord, meaning the base rent should be the landlord's gross profit at the end of the day. In all forms of leases, the tenant is going to be responsible for their own cost of occupancy. This includes maintaining tenant's insurance. The lease is often going to specify the exact amount and types of insurance coverage that are needed, so it's good practice to consult an insurance professional before signing the lease. In triple net leases, I mentioned that tenants are responsible for operating costs. Operating costs will be defined in the lease and will typically include expenses such as common area maintenance and utilities, cleaning services, garbage and snow removal, landscaping, non-structural repairs, and many other costs that the landlord will incur both with the leased space and the building as a whole. These costs are a component of additional rent, which will be estimated in advance by the landlord and paid monthly by the tenant. Generally, at the end of each year, there will be a reconciliation period. So the landlord will calculate its actual operating costs for the year, and there will be a period where adjustments can be made between the landlord and tenant to account for any discrepancy between the estimate that the tenant was paying and the actual amount of cost that the landlord incurred. It is important to read the lease carefully when it comes to this reconciliation period, as the tenant may have the right to challenge the landlord's calculation of operating costs, but often that challenge will be will have some strict parameters to it, both in terms of time and what exactly can be challenged. And sometimes the tenant may be responsible for the landlord's costs if they challenge the calculation of operating costs and are ultimately unsuccessful. So before entering a lease, a tenant should be very careful when reviewing the definition of operating costs to confirm exactly what they will be paying for as part of their additional rent. In some leases, there will be items that are not necessarily industry standard, such as capital or structural repairs, amortization or depreciation of equipment and fixtures, or even administration fees in addition to what's already included in operating costs. It is also advisable to get an estimate of these operating costs in advance of signing the lease, as unlike basic or minimum rent, operating costs are generally not actually specified in the lease.
If you have a plan to carry on your business beyond the expiration of your lease, it's important to ensure that your lease has a renewal clause. To ensure that you don't have any confusion with the landlord at a later date, the right to renew should be documented in the lease itself and not by a separate agreement. Renewal clauses will establish when and how the renewal is going to be exercised. And usually that requires that a written notice is given within a certain period of time prior to the expiration of the existing term. It's not uncommon for there to be very strict requirements on when notice must be given, such as not more than 9 and not less than 6 months prior to the termination date. Generally speaking, the lease will also include in the renewal term the amount of rent that will be paid for the renewal term. It's often set at the prevailing market rates. Tenants are sometimes successful in negotiating a cap on those rates. For instance, maybe a maximum increase of 10% from the year prior to the expiration, which allows a tenant a little bit more cost certainty moving forward. It's also advisable to have a mechanism in place to determine the market rent in the event of a disagreement between the landlord and tenant as to how that should be done. Renewal clauses typically only permit the tenant to renew if the lease is not in default. The language used in the renewal clause is very important, as often any defaults, even one that a tenant has rectified, may be enough for a landlord to deny the renewal. Some other items that you might see in a lease are improvements. Sometimes, as an incentive to the tenant, landlords will offer a tenant an improvement allowance and maybe a rent-free period or a fixturing period in order to permit the tenant some time to complete necessary renovations to the premises and to be able to allow them to open for business. The improvement allowance can either be structured as a loan, which is paid back over the term of the lease, or as a true allowance. Additionally, the landlord may offer a rent-free period for the tenant to prepare the premises. Usually the tenant will still be responsible for additional rent during the rent-free period, but not for basic rent. So again, it's important to obtain an estimate of additional rent in advance. Another thing to keep in mind with respect to improvement allowance is that there's many different ways to structure them. And so this may be an area that a tenant can put forward a proposal to assist them with their business moving forward. Rules and regulations are a form that the landlord may put in their lease. Often it's attached as a schedule to the lease, and it's the landlord's broad rules and regulations and procedures for governing the operation of the premise, particularly if there are common spaces that the tenant is going to be using. Because they're put in as a schedule, and the way leases are typically drafted in a way to give the landlord broad power to be able to revise the rules and regulations from time to time. Rules and regulations should be reviewed carefully, and it's advisable to ensure that the rules cannot be used in a way that would negatively affect the tenant. So for example, there would be rules with respect to access through main doors, parking restrictions, and mandatory minimum operating hours And so a tenant's going to want to make sure that each of those rules fits with the way they intend to operate their business. Some other terms which are important to watch for include that tenants generally will not have any right to terminate a lease early. And if they abandon the premise, there's often a provision that will leave the tenant liable for the rent for the duration of the term. Some other clauses you might see are non-disturbance clauses, which require a lender to maintain the lease after a lender has foreclosed on the landlord's property. A provision that would require a tenant to remove tenant improvements at the end of the lease and leave the premise in its original state. Relocation. Some leases will permit the landlord to require the tenant to relocate to a different part of the building or sometimes even to an adjoining property if there is a need for the landlord to use that space either for renovation or for other uses the landlord might have. The leases will typically also include restrictions on assignment and subleasing. So for example, a tenant operating a new salon or the new style of salons where there's often different spaces in there that are leased to subtenants would need to ensure that they have flexibility within their lease to be able to enter into those subleases. Further, you might want to check your lease to make sure there is a force majeure provision in it. New leases may contemplate termination rights in the event of a global health pandemic, as we recently saw with COVID-19. And leases may also include a overholding provision, and tenants should be aware of this provision because if a tenant doesn't exit the premise at the end of the term, a tenant is often deemed to be on a month-to-month lease, and that month-to-month lease will be at a higher rental rate than the existing rate, often 150 or even 200% of base rent. So the purpose of this presentation was geared to give you a really basic overview of what kind of provisions you might see in a commercial lease agreement. We're always happy to take questions on commercial leases, and if you have questions about specific provisions, we're happy to explain those provisions to you or assist you in reviewing a lease in full. We hope that this helps you to make your business a success and to give you some tips when you are negotiating with your landlords. Thanks for tuning in.